Stock and bond markets came out better than expected in 2023, despite rate hikes, wars, and collapsed banks. The chance of recession is dropping, but still exists. Markets may be more tepid in 2024. Bonds got a big boost at the end of 2023. We'll cover that and more today in this quarter's Quarterly Context webinar. Welcome to the webinar. WealthStep is an online financial guide to help 401k plan participants and other individuals make smart decisions about how much money they need to retire and how much to save and how to invest to get there, as well as providing currently blog posts and other information to help cut through the noise towards having helpful information and staying calm in sometimes challenging financial markets. These webinars are designed to help make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior to help you stay relaxed by staying informed and make better decisions for yourself. As always, we focus on the idea of the three major areas that drive financial independence: aim, save, and invest. Aim is figuring out how much you need, save is saving the right amount, and invest is primarily about using smart lifestyle investment approaches for each life stage so that your investment structure can be as simple and effective and automated as possible. We're going to cover some general information in the first half and then a quick general investment concept and planning review at the end. As always, we encourage people to think about what really matters, which is the space between things that matter and things that you can control. That's where it really matters to focus your time and energy, because you can't influence the things you can't control, and there's some things that matter that don't fall into the things that you can control. The big picture in terms of things you can control is defining your goals, saving consistently, life stage investing, diversification, and being a smart investor without being emotional during bumpy markets. So let's take a peek at some of the broader context of what's going on in the economy and the marketplace to have more perspective for better decisions. As always, there's a lot of news and noise that bumps markets around. A lot of what's continuing to be in the news is what's happening with rates. Are rates going to come down? Market rates are coming down, but the Fed hasn't brought Fed rates down. What's happening with inflation, employment, and so forth. But in the long run, all those elements smooth themselves out in a sometimes bumpy but long-term upward trend of markets. In the last year and a half or so, there have been 11 interest rate hikes by the Federal Reserve to try and rein in inflation, totaling about 5.5%. When rates go up, that tends to make for bumpy stock and bond markets, especially bond markets, because there's an inverse relationship between rates going up and bond prices, which go down. The inflation numbers have cooled quite a bit from the peak of 9.1%, hovering around somewhat stubbornly around 3.1% now. Stock market was quite strong at 12% for the quarter, and bonds, while below the stock market, was at a very strong almost 7% return for a quarter. That's an unusually strong number, given that there was the expectation that rates might start to come down on the horizon. That made bond markets happy and gave a preemptive boost to bond prices. Unemployment has been hovering around the mid to high 3 range. Economic growth numbers in terms of GDP, gross domestic product, 4.9% was the number that came out for the third quarter. That's quite strong and suggests to many that recessions are and a recession is less likely on the horizon. However, some economists still believe that's possible to have some sort of recession towards the end of this year or the beginning of next year. And somewhat unusually, all of the arrows are green and pointing up this quarter. The stock market, again, and the bond market, because of the expectation that rates would come down, markets got a boost. in anticipation of the effects of rates coming down. So quite strong in the US as well as international. And in the long run, the US is still very strong, above average over, say, 10 years. International, a little bit weaker, but some would say that international stocks and the international currencies are right now undervalued, and so may have more opportunity moving forward for a while relative to US currency and stocks. But no one can predict exactly when that will happen and how much. You can see there's been a lot of strong returns in the last period since March of 2020, the low during sort of the COVID low and related to the interest rate hike period as well. After that cooling, stocks really took a boost, and in particular, large cap growth. Some of the very big tech companies performed particularly well within the broad US stock market. Other areas did quite nicely as well, but not as well as large growth. However, oftentimes when there's something this strong, it tends to cool a bit, so the other areas may be better positioned and rewarded in the future. Not suggesting anyone make any tactical moves. It's just a reminder to be patient for the areas that might be lagging, and don't be too excited about the areas that may feel like they're doing particularly well in the short run. In the long run, we can see here 4 major market downturns and their recoveries. The Great Depression, the bottom one here, the dot-com bust and recovery in green, the oil and financial crisis of the 70s, and then the more recent global financial crisis and Great Recession, followed by the COVID dip, followed by the interest rate dip. And this more recent decade or so has had a stronger return after inflation. This smaller chart here shows before inflation, but this after inflation chart is really the returns and the spendable money adjusted for purchasing power that you get to keep, and that's what's been stronger in recovery in this last 10 years. So some economists think that there's still a chance of recession, given that the effect of higher interest rates of the last year and a half or so can take a year or 18 months to work its way through the economy. So there's still a question about what might happen in that regard and how much cooling the economy might have. Inflation has cooled, as mentioned, but it's hovering stubbornly around this level. That may cause the Fed to wait on lowering rates, and that may make markets a little bit nervous. And overall, a big component of inflation has been fuel prices, and fuel prices have been coming down, although not anywhere near the lows in the last decade. If we look at Federal Reserve rates, where they've been and where they're projected to go, you can see ratcheted up before COVID, then dropped down again. Here was brought way down to stimulate the economy around the time of the global financial crisis and Great Recession. So the Fed uses interest rates as a way to stimulate the economy. The lower rates are, the cheaper borrowing is, the more people and companies can borrow at a lower rate, which accelerates spending and can help economic growth. The problem is the Fed doesn't want, if when inflation, or rather interest rates stay low for a long time, that can lead to higher inflation, and that can damage the economy. So now the Fed, with inflation coming up, the Fed has raised rates to try to rein in inflation, and believes that now have hit the peak of rates and that rates will start to come down. The market expects it to happen in the pattern here in green over the next few years. The Fed thinks it will take a little bit longer for rates to come down. What was interesting during 2023 regarding bonds is that during the first 10 months, it was flat to bumpy after a big negative return in 2022 because of those higher rates and rates going up. Then for most of the year, the market believed that rates might go up again, which would have a negative impact on bonds. But when the Fed signaled that rates would stay flat and likely come down without any more rises, the bond market jumped quite a bit, to a total of 8.5% over the course of the last 2 months of last year. That is a big jump for bonds, which have an expected return in the long run of about 4 to 5%, something like that. So that's a good reminder not to panic whether it's stocks or bonds, and to hold the line and hold your long-term strategy if it makes sense for your life stage, because when markets cool, they tend to recover. You just don't know when that's going to happen. And as a reminder, given that rates are going to start coming down sometime in the next few years, people who are holding money in money markets will see that come down. If it's long-term money, it makes more sense to have that money instead in a longer-term portfolio of stocks and bonds of some sort, depending on your time frame. For people who are still sitting in cash, there are money market and other vehicles that are paying a lot higher than zero. Most cash bank accounts are paying 0% or checking. So that can be an opportunity to earn a little bit of extra interest, especially if you don't need the money immediately. Of course, checking and savings is a good place to hold money if you're going to be spending it very soon, because it's very easy to access that way. As a reminder as well, since there are always bumpy markets on the horizon, we just don't know when. This study shows that over the 34 years ending at the end of 2022, the stock market had a 10.4% average return. That's the US S&P 500 as an example of the stock market. If you missed, however, just the 10 best days during those 34 years, your return would have been 8%. If you missed only the best 50 days over 34 years, you would have had a 2.6% return instead of a 10.4% return by just staying put and being a long-term disciplined investor. Amazing numbers, just a great reminder not to try to guess, because if you guess, you get out, the market goes up, you miss that, that's when you really can lose either money or recovery. So let's do a quick peek at retirement savings concepts, sort of perennial things to remember. One of the key ideas is to get a handle of how much you think you might need in retirement. Write out some numbers, think about how much you spend each year, how much you might need to spend in retirement. That can help you get closer to a sense of how much you might need in total. Then most people should be saving 10 to 15% or more. If you start young enough, that will very often get you where you need to go if you're investing wisely. However, if you started saving late, you may need to save more than that amount. And if you started saving extra early, say before your 20s or very early 20s, there's a chance that you could be towards the lower end of this range, or even a little bit less, depending on your goals and your spending and so forth. So some general rules of thumb here to keep in mind to try to get on track for your retirement readiness goals. And then investing is not about guessing what to do, it's about being a long-term disciplined investor by life stage. Because one of the things we see with regards to saving is that sometimes people don't save, say, oh, I'll do it later, but then the older people get that say that, they say, oh, I wish I had done it sooner. It would have been so much easier if I just saved a little bit more then, rather than trying to save now or not being able to stop working at all if someone doesn't have sufficient retirement savings. In the very long run, stocks do very well. There's lots of bumps along the way. Just know that that's normal. Bonds in the middle, not nearly as strong as stocks, but they are a volatility dampener, which can be helpful, especially as you progress through your years and approach and go into retirement. So that's part of a diversification strategy, the portfolio. And then treasury bills, sometimes referred to as cash equivalents, and bonds are fairly smooth ride, but the dollars that they produce are not nearly as much as stocks. So and barely beat inflation in the case of cash equivalents. So sometimes people feel like they're being safer by being more conservative in their investing, but oftentimes it's much riskier because you're risking retirement readiness. So these are important concepts to get a handle on. And in the long run, people who stick with a portfolio, this is using an all stock portfolio as an example, might over this time period of about 20 years had a return of about 8%, but people who got in and out and moved around trying to guess, either because they were worried or trying to find opportunities, end up doing about half that return. So sometimes doing less and less movement is actually doing more with a higher return. So it's very difficult to guess what the market will do at any given point in time. When WealthStep is launched, this is one of the screens that you will see. Planning advice to help you figure out how much you might need investment advice to help you figure out what to do by each life stage. That's particularly simple if you're in a retirement plan, for example, with target date funds, because those target date funds automatically already adjust for your life stage. There's educational videos which are available now, and there's also blog posts, as mentioned, if you go to the blog area, different topics to help you stay focused on what matters. And once other parts of WealthStep are launched, there will be options for people who need help outside of their retirement plans. There are options where there's a fee for investment management services as well as the online advice. There's a free basic public version that has less of the advanced planning, but can help people. The idea there is to help as many people as possible get on track, especially those with smaller investment accounts or lower incomes. We want to make sure people are getting on track for financial and retirement readiness. So aim, save, invest, all of that helps you prepare to spend in a way that makes sense and that's sustainable for you, so that you have the money you need in retirement to enjoy the life you want to live now and then. And remember to be smart about understanding risks, that fighting inflation and fighting the idea of running out of money too soon is even more important than trying to avoid market volatility. Market volatility actually is associated with a reward in the long run in the form of returns. So thank you very much for joining, and we wish you all the best.